Hi, everybody. We're back at 1:30 on August 8th. We have a great webinar. Our guest is Angie Setzer. She's been working in the grain industry for over 11 years. After beginning her career as a cash grain broker, she transitioned into the vice president of grains for Citizen Elevator. And, Angie, welcome.
Thanks for having me.
I just gave you a little intro, but I kind of stopped. There's about 10 other things that you do, and so I figured I'd let
Yeah.
you get into that and take it from there. Tell us a little bit about yourself and your background.
Yeah, I am a cash grain trader. So I am one of those folks that when you see the elevators dotted across the countryside here in areas across the Corn Belt, I am responsible for, basically filling those up, emptying them out, and making sure that the company makes money on that sort of thing. In addition to that, I also work very, very closely with a few hundred farmers, I would say, not every day, of course, but throughout the year, and help them do better at marketing. How do they trade their grain like an elevator? So I basically teach them to pay attention to the stuff that I pay attention to, which is in the cash grain market. Of course, futures is very important, but to me, my focus tends to be more on spreads and basis, which is the difference between the cash price and futures.
So take us through that. How exactly? So you talk to a lot of different farmers. You try to teach them about the basis, things like that. How are you getting that information? Is it based on just talking to everybody? Is it fundamental? Is it technical?
Yeah, well, it's a function of local supply and demand. So basis functions, differently in each area that one can trade. So, if you're in central Iowa, what is taking place with the local market structure is extraordinarily different than, for instance, what I'm looking at in Michigan. And so a lot of that is just knowledge, experience, understanding of what you're up against, both on the supply availability side and on the demand side, because it's a physical product that you're focusing on. So basis there, really is one of those things where a lot of folks will say, well, how do you learn about it? You really there's no one way that it trades. There are seasonals that you can pay attention to. Grain tends to flow easily certain times of the year and more difficult other times of the year. So you acknowledge that sort of thing. But yeah, I mean, basis is a function of futures as well, because if the market is rallying and the farmer is receiving more, the basis can tend to widen. So if you're sitting here as a buyer like I am, looking to take a long cash position, long physical ownership, and the market starts to rally, the reality is you probably need to offset that position with your end user or intend to hold it, because futures market going up tends to weaken basis and vice versa. A collapsing market structure can strengthen values, and then spreads play a very important role too. What are you making on holding that grain? So we've seen that specifically in wheat. If you look at the wheat spreads, the Chicago wheat spreads, set March right now is 42 cents. That has a huge influence on local or nearby basis values as well. So it all tends to play together, and it's one of those structures in the market that no one person can tell you exactly what basis should do, just because it's so variable across the countryside.
Right. I'm sure that's always changing, and it's a very interesting time right now with the global trade wars directly affecting the ag market, and we're seeing right now wheat over the past few months has gone up while soybeans has gone down. Is that something that you look at in terms of those sort of spreads?
We do pay attention to it. Not, I don't pay too much attention to it. There's an ongoing joke in those that trade eggs that you can make anything a spread, of course. And there was some talk. I had someone reach out to me this morning about what was taking place when it came to soybeans and wheat, and where those two markets tend to typically trade. The more closely related market spread that you would look at, or intermarket spread, would be like corn and wheat. So that is one that I'm paying very, very close attention to, simply because typically corn and wheat, the corn wheat spread tends to be wheat runs about a buck 35 higher than corn. If you look at it right now, it's a buck 95. So to me, either wheat's too expensive or corn's too cheap. Now, that's not a definitive statement by any means, because both can have very different fundamental pictures or different interest in one versus the other. We saw wheat trade $2 plus over corn, for an extended period of time, several times in my career, 2006, 2007, 2010. We've seen corn flip and become more expensive than wheat, which was even more rare and unexpected. So you tend to have it should trade this way, but it's not always guaranteed. But right now I'm definitely paying attention to what's taking place in the corn wheat. And then with wheat valued at 605 for next July, when most farmers are looking to harvest, there is an idea right now, if you're looking at $6 wheat for a farmer versus $8.50 soybeans for Nov 19. Right now they're 944, but you have to take that basis off. There are some farmers making decisions that they'll plant wheat this fall that may tap into either some of their corn acres or some of their bean acres once they get into the spring planting season.
Interesting. So take me through the way you actually analyze the markets and kind of, look at the individual components and kind of come away with your conclusions.
I'm a major fundamental trader, for sure. I joke that I'm a backyard tech trader. I pay attention to support, resistance, old highs, old lows, consolidation, things of that nature. But I am always amazed by people who are hardcore tech traders, because I'm not that mathematically skilled, I guess you could say. For me, I pay attention. The biggest thing I pay attention to is ending stocks and what we're looking at when it comes to ending stocks. So for corn and soybeans, the marketing year ends September 1st. And whatever is left over as of September 1st is what we carry into the next crop year. It's our buffer, you could say. So for instance, right now in the year, I'm paying attention to production ideas and what demand looks like as we go forward, because that'll all have a huge impact on what we're looking at when it comes to carry out for next year. So overall, it depends on the time of year, what you're paying attention to. Usually in the wintertime, we pay attention strictly to what's taking place demand-wise in what we call old crop. So what's happening in the nearby market setup? So if export sales are stronger than anticipated or stronger than they need to be, and shipments are strong, that's bullish because that's an indication of increased demand. If ethanol usage in corn is stronger, or crush in soybeans is stronger, we get reports out. Ethanol is weekly, exports, shipments and sales is weekly, crush is once a month. Those types of indicators, and then as well as the supply and demand outlook each month from the USDA. So that's the kind of stuff that we tend to pay attention to as a fundamental trader throughout the winter into the spring. Once spring gets rolling, once you turn the calendar over to about April 1st, April 15th, you start paying attention to weather, planting conditions, planted acreage, what we're looking at, and start trying to guesstimate what overall new crop production is going to be. And about the second week of May is when we start paying attention to what our new crop outlook could be. So, for me overall, much of what we pay attention to is supply and demand, ebbs and flows, what's taking place there from a report standpoint, and what we anticipate to take place and in subsequent USDA reports. And then of course we have to monitor what's taking place geopolitically, trade and open trade or closed trade or trade wars or whatever it may be, could have a huge impact on export demand, from a hypothetical standpoint and a real standpoint. But so we pay attention to what's taking place there, what's happening, wars. You have to watch what we saw wheat rally big time when we had the Russia-Crimea situation, stuff like that. So you're constantly watching to pay attention to what's taking place in other countries, especially those in emerging agricultural hotspots like the Black Sea region. Pay attention to weather constantly, currency, what's taking place. I especially I have to pay very close attention to what's taking place with Canadian US currency fluctuations, because being in Michigan, we do a lot of open trade back and forth with Ontario. And so if their dollar is strong on any given day, then they may be more aggressive when it comes to purchasing our crop, which means basis strengthens in Michigan. And the opposite is true. If they're not looking to purchase, or if they're looking to be active sellers, then our basis can weaken. So I'm paying attention to currency moves as well. Currency moves with Brazil, Argentina, what's taking place, because with the southern hemisphere being so big in corn and soybean production now, Brazil, Argentina, surrounding countries, we're always in the middle of a production season at this point in time. So, you're just constantly watching what is taking place from a supply outlook and demand intentions and every other little piece that fits in.
So what crops are you mostly? What are there, 2 or 3 crops? Is it corn and soy that you're most active in?
Yep, corn, soybeans, and wheat. And then I'll pay attention to cattle, both feeder and fats. So feeders are the ones you're making into fats, and fats are the ones that will be your steak, in 2 weeks or whatever,
Right.
and then hogs as well. Mostly cattle and hogs, because of those are just markets that have an influence on overall demand, via feed and things like that as we move ahead. But corn, soybeans, and wheat, the Chicago wheat specifically, that's the soft red wheat, is what I handle day in and day out.
And so, do you directly deal with any exports to South America, or it's just that a lot of others do, and so it's something that everybody has to pay attention to based on supply and demand, and how that might affect other things?
Yeah, a lot of others do. It doesn't necessarily, well, it can impact me directly, but I'm not the one making the trades. I'm not the broker on the export side of things. But if South America has more active supply available to ship into the global marketplace in September and October, it'll have a huge influence on what my Toledo demand is, because they'll load boats in Toledo during harvest time. And if South America stepped in and filled the pipeline, then of course the Toledo demand will weaken, and what I can pay farmers and what I'm going to get paid for the product that I take in at harvest time, could be reduced because of that. But I do not focus or handle those types South American imports or exports. My export structure would be, and my import structure, of course, would be just the Ontario market setup.
Yeah, and then getting back a step from one question, because one of the reasons I asked that is because the currency moves in those countries more specifically than Canada are significantly more volatile. CAD,
Yeah.
it's been trading in a few big figure range for a little while.
Yeah.
Those currencies have been moving 10-20%, which makes it a significant factor.
And it has a huge influence too, because the farmers in those countries convert their crops into dollars. So the weaker their currency, the more they're getting. And so you'll see farmers in Argentina and Brazil use their crops as a hedge against currency moves. So you may see them have a big crop, but if they have concerns that their currency could collapse or strengthen, it'll influence whether or not they're aggressive sellers and willing to fill the pipeline. So we've seen that in Argentina specifically, where they've set aside millions of bushels of grain simply because they want to make sure, they're not being taxed heavily, because in Argentina they have a whole bean export tax, and they had a corn and wheat export tax until their recent president was elected, and that influenced their ability to ship into the global market structure. But also because they knew that if they were to see a collapse in their currency, if they were to sell their beans into dollars, they would get more. So you've seen, just recently, Brazilian farmers, even with the drop in futures, which they use our futures market to help build the value on their crop down there. Even with the drop in futures, they were seeing, near record high cash prices for their beans in the country.
Right. So right now we're in the middle of August or beginning of August. What do you think are the 2 or 3 biggest things that you're looking at for future direction, for whether it be wheat, soy, corn? What over the next 6-8 weeks is really going to be the biggest drivers?
The biggest thing, of course, is trade. We've got to see what happens with China, and what takes place there. There's talk that over the next few weeks, China's going to have to turn to the U.S. Simply because Brazil just does not have the capacity and the ability to handle the demand. Of course, there's talk that China will be able to ratchet back that demand, et cetera. But we did see their bean prices spike domestically yesterday out of concern that supplies were dwindling or could be dwindling, and that processors are going to need supplies. So of course we're going to be paying attention to trade. NAFTA, Mexico is our biggest purchaser of corn, and they're a big purchaser of wheat. They do like our soybeans as well. So we got to see what's going on there. Canada and the US, of course, work very closely together. So we'll be watching what's taking place with NAFTA and China. We'll also have an idea, or a better idea, over the next couple of 3 weeks as to what we're going to be looking at with production. So right now, a lot of the talk about corn yields, bean yields, and things of that nature is basically hyperbole. Maybe it's based on USDA weekly condition updates or something of that nature. But now we're going to be able to have tours. We'll have crop tours go out where, literally hundreds of people will go out and spread out across the Corn Belt and check fields and give yield estimates as to what they feel the crop will look like. So this year has been a bit of an anomaly, simply because we started with such a wet June across much of the higher producing areas. And then we had a hot and dry July that finished a little bit cooler. So the question is will that matter? And now we have to see what August weather is going to bring. So there's a lot of uncertainty as to what we're looking at from a crop standpoint. So that's going to be important as well. So really over the next couple, weeks here, we're going to be focusing on USDA. We have a USDA report out Friday. We'll be focusing on what they have to say, what their updated numbers look like, and then overall what we're seeing from a production outlook standpoint. And then what happens with trade. Trade's huge. Right now we've had a lot of really negative headlines come out for trade, but when you look at new crop supply and demand and export sale numbers already, you'll see that corn is tied for the second largest amount of new crop, which is September 1st going forward, export sales in the last 5 years, and soybeans are third. So even though we've had negative indications, via headlines that export demand is weakening, we are not seeing that from an actual information standpoint. So we're going to be watching that very, very close.
Right. Well, it's funny. The first two things you pointed out before were China and NAFTA, basically both political, and then then you got into more of the fundamentals of things. But it's really politically driven right now. I guess all the farmers are keeping a close eye on things.
Yes, very much so.
And I had one other question here from the. So in general, how would you say the way the market has changed from 10 years ago to now, in terms of the way it trades and the way you might have looked and analyzed 10 years ago versus now?
Yeah. Oh, it's a huge difference. For us 10 years ago, and it was starting to dwindle, but it was still very, very much there. You had the CBOT, you had the pit trade, you had, you could tell by calling down my brokers were on the floor in Chicago. So if I needed to put a hedge in, I could tell how busy and how active the market structure was based on how loud it was in the background. Now, and in that structure and having someone on the floor, you could hear if some of the big dogs, the ABCs of the world, ADM, Bunge, Cargill, Dreyfus, if they were unrolling or doing certain position trades or something of that nature, you knew that was taking place, and you kind of could make a decision at that point in time if you were going to follow, or if you felt that the market structure was a different one. Farmer information was much slower. When I first started trading in 2005, 2006, I started putting a newsletter out, and I would bet that 95% of my farmers did not have email, let alone internet. So now they have a lot more information. They're a lot more well connected to what's taking place around the world and locally on top of that. So that's been a big difference. Farmer information has definitely helped. On-farm storage has helped as well. So the ability for a farmer to hold his grain or his or her grain out of the pipeline has changed how the market structure is set up. We had ethanol introduced. So we had an additional 5 billion bushel of corn demand come into play, versus 10 years ago, we were just in the start of the ethanol boom. So technology has made a big difference. Our demand structure, China wasn't as active in our soybean purchasing side of things. Soybeans weren't as exciting 10 years ago. I mean, you could look at a chart and see soys basically traded right around $5 a bushel, nearly half of what they're worth now. And so the demand structures were very different. Technology made it very different, especially when it came to trade. In 2008, I would have to call and talk to a broker and put in a trade. And even if I was selling at the market, I'd have to wait until the end of the day to recognize where my value filled. Now I'm entering my own orders, making my own spread decisions and things of that nature. So it's definitely been a night and day difference. Not only that, but when I first started, you didn't have the outside trade, the desire or the idea that CNBC would talk about soybeans on any given day or something like that. You didn't have the hedge fund interest in the ags, it seemed. And so that also can make things exceptionally interesting to watch, just simply because you can get those outside fund those major swings to the upside or downside based on whether or not it's viewed as a good trade or not by those outside of the ag sector as well.
Yeah, that's interesting. So as a whole here, would you say that you, over the coming months and quarters, are you bullish or neutral or bearish? Like, what are your thoughts on corn, wheat, soy?
To be completely honest, in wheat, I think we're fairly priced. If anything, maybe a touch high when it comes to fair price values for what's taking place. We are one of the only providers. When I say we, I mean the U.S. We have plentiful, what you could call somewhat abundant supply of wheat available. The problem with our wheat market structure is that you have such wide spreads. So it's making the basis, like I said before, nearby basis exceptionally strong, which is kind of pricing us out of the export market. So we really got to see what is taking place there. We've tend to see it happen in the past where we over assume that there's a major crop failure with wheat. So we'll know a little bit more here as the Northern Hemisphere over the next couple months kind of wraps up harvest, and we'll see how the Russian market develops and things like that. Right now, there's a lot of speculation over what's going to take place when it comes to Russia and the Ukraine in their export outlook. Russia, of course, became the largest exporter of wheat a year ago, and this year they had a substantial reduction in production. So we'll see if they come into play or if they have to mitigate some domestic bread cost increases or something of that nature. But to me, I think until we know more in wheat, I would say we should kind of tread water, maybe even weaken a touch, because in addition, we're seeing a big incentive for guys to be planting wheat next year. So we could see a big increase in wheat acreage across the Northern Hemisphere, as we look ahead. We'll be watching what happens with Australia too. They're really suffering from hopefully once in a generational drought. They've been dry the last 5 years and they just keep getting drier. So for wheat, for an overall standpoint, like I said, I feel it with what we know now and what we're looking at, you could say we're relatively fairly priced. Corn, I am bullish, barring any sort of surprise from the USDA. So last year we had a record corn yield of 176.6 bushel per acre, which to a lot of people is very Greek. But it's important to pay attention to simply because each bushel that you take on or take off in domestic production is a bushel, or is actually 82 million bushels added, because that's how many acres we'll harvest. So as long as the USDA doesn't come out and shock us with a yield, well above 176, which tends to be where the trade's at right now, I am bullish corn. It's simply because there are two people in the world right now that have corn available for export, and China is one of them, and they are not going to be exporting their corn. The quality is they have a lot of damage, a lot of questionable quality that's not going to make it into the pipeline, which is why they've increased their ethanol grind and things of that nature. So between the U.S. and China, I think we account for over 60% of the world's corn, 64% of the global supplies. So I joke that the U.S. is kind of like the Kmart of the world right now. You may not want to shop at Kmart, but if you're in a small town in Iowa, that's your only option, and that's the US. So our corn export demand should be pretty strong. When looking at the global stocks to use, you get to next year, the end of the marketing year, SEP 1 2019, without any major shift in production, to the upside, you're looking at the second tightest available supply, the tightest in over 40 years, second tightest on record. So that's something that, in my opinion, cannot be ignored, especially if we were to see the trade issues continue with China and Brazil be encouraged to plant more soybeans. That means that we will not see an influx of newly available corn supplies aside from the U.S. Until next June from Brazil when their second crop comes aboard. So for me, I'm quite optimistic on the corn side of things. I think we could be in for a wheat-sized surprise when it comes to upside on corn. And I'm going to be completely honest, I'm phoning it in, I guess you could say, on soybeans, but I think you could flip a coin at this point in time. If we were to see, soybeans are a bit different just because you're not talking about billions of bushels of leftover supplies being comfortable. You're talking about hundreds of millions. So in soybeans, a 2 bushel to the acre shift in production one way or the other has a huge influence on stocks to use and carry out. So we're talking about the difference just simply with 2 bushel to the acre of a 300 million bushel carry out, which would be considered bullish, with or without China trade issues being resolved, or a 800 million bushel carry out, which would be the extremely bearish. So in my opinion, soybeans could easily go a buck one way or the other just based on production. And right now, August is the month that we pay attention to. So if you see August weather turn hot and dry over the next couple of weeks, then I think you would see the market start to really strengthen in the idea that we see a yield reduction and could have a bullish supply and demand scenario start to pop up. Or if you see it turn cool with heavy rainfall across the Corn Belt, the opposite could be true, and you could see soybeans try to put in some new lows. So soybeans are a tough one. Wheat, I think, is very fair, and corn, I'm quite optimistic on price direction.
Oh, that's good. Good information. And, sometimes, like you said, with soybeans, it's you're neutral. We'll wait and see.
Yes.
So what's your thoughts on this? So about 10 years ago, I was working for a macro firm, and we started an agricultural fund. And the theme of why we were starting the fundamental ag fund was because global population demand was going to be increasing. People were turning farmland into parking lots, and population increasing, and so demand increasing, but supply going down. But over the past 10 years, we've seen just prices either stay low or really haven't done a whole lot, but if anything are near historically low levels in pretty much the majors, corn, wheat, soy. What are your thoughts on that, of why it hasn't really gone up, and what will it take to make prices, really move significantly higher?
Yeah, I mean, we really jumped the gun on the whole feeding the world mindset. And I talk about it a lot when I travel and speak to farmers, because that's the question they'll ask me. What happened to us needing to feed the world? Because when I first started, 10, 13 years ago, that was the push. We have to feed the world. Exactly what you said. Population's growing. We're losing farm ground, et cetera, et cetera. Well, the one thing that we saw happen, really, if you look at the chart in 2012, you saw, not only the significant increase in demand via ethanol, like I said, 5 billion bushel plus of an increase. You saw China come in and start buying billions of bushels of soybeans, round about 2009, 10, 11. You also had a once in a generation, we hope, drought. So you had a significant increase in demand leading up into that 2012 timeframe, combined with a significant, unprecedented reduction in supply availability. That, of course, combined with the idea that commodities were exciting, that we were going to see inflationary pressure after the 2008 influx of cash, around the world, kind of triggered this move, significantly higher across the market structure. You saw $17 beans, you saw $7, $8 corn, out there. And so what that did is it increased the world supply. So that encouraged farmers in Russia, the Ukraine, across parts of Europe, South America, especially. If you look back at Brazilian production, prior to 2009, they really weren't even on the map when it came to global supply availability. So we went from thinking that we were the only country in the world capable of supplying and feeding the world to suddenly finding that a lot of countries across the globe, they have people that like to farm too. So you saw this huge increase in supply, as a response to these high prices. So high prices cure high prices, right? And that's what we saw. When you look at the long-term fundamentals of what's taking place globally, I think you will find that demand is not far from going away. Ag is not dead, is what I tell a lot of my customers, because you're simply looking at developing nations. You look at China population growth. You look at India population growth. You look at the developing nation growth, across the world, and you see the developing nations are expected to see their population grow nearly double that of developed nations. Not only that, but you're also seeing wealth growth take place around the world. So, if you have more money to spend on food, you're going to spend more money on, the beef, better cuts of pork, butter, dairy, things of that nature. So when you look at what the USDA is projecting when it comes to what's going to take place globally for demand over the next decade, it's really surprising and really encouraging to see that we're going to continue to see the demand growth. Now, for a farmer, I always tell them the last thing they want to see is $5 or $6 corn again. I know as an investor, the last thing you want to see is a lack of volatility in a market structure. But the reality is, for us, we'll continue to see demand strengthen. We'll continue to see ebb and flows of available supply and things of that nature. So we'll have opportunities to price here or there. But the demand hasn't disappeared. We are starting to see, or we are continuing to see, farmland disappear here in the United States. If you look at some of the major elevator companies out there, ADM, Cargill, Bunge, I've mentioned them before, they've all come out and said it's a bit difficult of an environment to function in here in the US because the farming is becoming more consolidated. That doesn't mean that it's not family driven still. It's just a lot of the family farms that are successful are able to get a little bit bigger. You're seeing a little bit more of a consolidation there. And it's a little bit more difficult to function as a big elevator company in this market structure. So they are still looking to expand because their role in production agriculture is you're seeing them pop up, across South America for sure, across the Black Sea region. They're really looking to grow and expand that type of production as well. But money is going to continue to talk. And to me, honestly, I think with the demand that we're looking at and the changes, the more volatile weather systems across the world and things like that, you're going to see that we've found a support in price. I would go out on a limb and say we've probably seen the lows, at least for corn and wheat this year, and probably soybeans. I know I just said, talking out of both sides of my mouth here, but I'd say based on that continued demand growth, the developing nation growth, the wealth growth that you're seeing, the reality is, a lot of talk here 2-3 years ago was we were awash in supplies. We were going to be awash in grains and things of that nature, and they needed to go to zero. Well, I don't think that's reality anymore. I think you're going to see an increase in volatility in trade, but I think you'll see a very, hopefully, more range-bound market structure, so to speak, just to kind of keep things in check, because those high prices, will easily encourage a huge increase in supply availability and of course result in much lower prices because the demand isn't going to pop up overnight.
Yeah, that's a great answer. So how do you analyze risk, and how do you talk to the people you speak to about risk when you're discussing about possible, there's a lot of different variables right now, but, from short-term traders that, when we're looking at the market, we have a stop in the market, typically, it's more defined from that side. So, how do you analyze risk?
Yeah, for me, when I'm working with my customers, we have a very good relationship and have a lot of communication about what is on the line for them. And a lot of times I will talk to them about, remove your emotion. That's the hardest part for a farmer. I joke that, when a farmer produces grain, they're his bushel babies. He spends months, cultivating and producing this product, the last thing he wants to do is just give it away or feel like he's not working his or her hardest to maximize value. But the main thing is you have to know the costs associated with your ownership. And that's both from a farmer standpoint. What is your cost of production? How much is it costing you to produce each bushel of that grain? What's your cost per acre? And taking a look at that. As an elevator manager, I have to look at my costs. I know what I'm paying a farmer or a group of farmers when they deliver their grain at harvest time or at any point in time throughout the year. And I have to look at it, what did I pay and what can I gain? And so it's the same across the board. And so, from an overall risk management standpoint, for farmers, it's a bit different because they're focused way more intently on futures opportunity, and then in the hindsight, we work on basis and to help maximize their money. But we have to take a look at what that cost is per acre, what their target revenue is per acre, what they're looking at from a space availability. You can't hold grain you have no room for. You can't pile corn in your driveway and think it's going to be okay. It doesn't work that way. So if they have to deliver grain right at harvest time, we pay attention to that. What are their cash flow needs for farmers? A lot of times they have cash flow needs throughout the year. Landlords need paid in January, John Deere's due in February, taxes in March, something like that. And so those are things that we have to take into consideration. You can store grain for a long time. I mean, you make it cool and sweet. You get the moisture down and have it in a secure location that's dry. You can have grain for multiple years. But unfortunately, most farmers don't have the ability to wait out a market downturn simply because they have to generate cash and they have to generate space before the next harvest comes in. So those are all things that we talk about on their side, from a risk management standpoint. For me in particular, I have to focus intently on spreads and basis. Spreads more specifically than anything, because those are my initial, that's what I pay attention to initially to figure out what is going to pay me to hold grain. Basis, I can tend to have an estimate as to what's going to happen, but I really need to make sure that if I'm paying X at harvest time, not only am I getting covered the 4 to 10 cents per month it costs me to hold that commodity, but I'm also making enough to cover my put through, which tends to run 15 to 20 cents a bushel, as well as make margin. Not only margin to keep the roof over our head, but also keep the lights on. So there's a lot of factors at play when it comes to managing risk. And sometimes in commodities, that means you make a decision and then you supplement those trades with options. Maybe for a farmer, they're looking at selling cash grain, and if they're still bullish the market, they may own a call structure. Right. Above that. I'll look at CSOs, the calendar spread options for me. I haven't in quite some time, but I did when it came to holding, food grade soybeans, because we export direct into Japan, these food grade non-GMO soybeans. And so if you have to carry those from one crop year to the next, you're constantly trying to be aware of what's going to happen in the August-November spread. So we've used CSOs in the past and stuff like that to help manage, that secondary risk. And then in addition, farmers have the ability to tap into crop insurance, multi-peril crop insurance. They have hail policies to help cover if there's a major storm that destroys their crop, or if there's a overturn from the field to the bin, or a fire or something like that. They can tap into those types of insurance policies. And they can also supplement, unsold grain via puts or something like that. So there's a lot of moving parts, and we'll incorporate options as needed as well to help manage some more of that risk.
Yeah, that makes sense. So I got to back up. You made a comment that I had to write down because it surprised me. You said that you can store grain for years. So
yes.
If corn, take corn as an example. When you actually pull up corn, how long can you store that for before it goes bad?
If you're constantly monitoring and moving it, and you are aware of what's taking place, you aren't just putting it in the bin at 18% moisture without any airflow and seeing what happens. I mean, there's places that'll hold 2, 3, 4, 5 years of it and have it come out, relatively well. Bins nowadays have coils, temperature coils. They can tell if there's a hot spot. A hot spot tends to indicate that you could be losing that bin. You can maneuver around, pull out the grain enough to move that hot spot, just kind of break it up a little bit. Maybe you ship it, maybe you put it back in on top. We discuss, quite explicitly with my managers about what they call coring the bin. So you pull out the center of the bin in order to allow airflow. I've held wheat for 3 years plus.
Wow.
There's wheat in Toledo that, has been held for, the rumor was it was close to a decade. I would probably say 5 to 6, 7 years, as they blended out quality issues and stuff like that.
That's
So
unbelievable.
it is. A lot of people don't think that. So, there was, when we
I
started
never knew that.
when we started to see talk of trade panic, there was someone that tweeted about soybeans turning to soy sauce in the bin. First of all, that doesn't happen. They don't go from beans to soy sauce, although that would be delicious. If they're put into the bin properly, we have a way to observe. There was a local ethanol plant that they had to pull in. They put out a ground pile, 1,000,000 bushel of corn out in what they call a ground pile. It's a tarp underneath it. It's a bin somewhat structure over top and a tarp over top of it. And they realized that their carbon monoxide was increasing in this pile. So they knew they had to pull it in. They were going to lose it otherwise. And so the observation and the technology that is used to monitor the quality of grain stored in our bin structures nowadays is phenomenal. And it allows for long-term storage if the grain's properly put away, for one, and then properly managed as it sits there.
Well, I think that the last word you just said there is exactly what I was going to get at for the next point. Of one reason why possibly prices have not popped at all is our technology is so superior to where it was 10 years ago, 20, 50 years ago. I mean, I now watch on YouTube or different things like amazing. I'm mesmerized by sometimes seeing the tractors and different farm equipment that can harvest, and just the way it does it, opposed to a human walking through the fields. And then you just even pointed to the fact that we can store this for years and years. It's the combination of both those. I mean, it's remarkable.
Yeah, if you look at our yield increases in corn specifically, I mean, when I first started trading, 160 bushel to the acre was mind blowing nationally. Now we're talking, at one point this summer, we were talking about the idea of 180. So, if you talk to farmers, they have satellite technology. They can see all of their fields. Certain farmers can see all of their fields. They can detect if there's an issue, if there's insect pressure. They can spot handle weeds, insects, any sort of issue like that. They have variable rate technology, which means that a farmer is going to go out and not only use maybe an increased amount of seed in certain areas and lighter seed in others, combined with grid sampling when it comes to fertilizers and things like that. So farmers nowadays, I wish I could find I'm going to have to find the actual number on it, but farmers nowadays are capable of producing a heck of a lot more. So farmers are now producing 262% more food with 2% fewer inputs than in 1950. And that's a statistic from a couple of years ago. So I would say that, farmers are now working to try to limit the cost that they put out per acre, and working to continue to increase the amount of food that they're able to produce. And that's, really a testament to how awesome technology is nowadays and what they're capable of doing.
Absolutely. Like I said before, sometimes I've watched some of these videos, whether it be on Twitter or YouTube, whatever. It's amazing to see how the crop rows, how they just, whether it be de-weeding or whatever the technology is, it's just tremendous. It's amazing.
Yeah, it's definitely come a long ways. That's for sure. And the understanding of what each field needs, and like I said, I mean, grid sampling. So you could have a farmer tell you exactly what each 1 acre increment in a 120 acre field, they can get right down to the prescription of what's needed for, lime application or something of that nature. Even it's phenomenal.
Yeah, that's amazing. So I'll get you out of here with one last question, and it's more directly to the markets right now. So, obviously it's a lot of trade talk, a lot of NAFTA talk, like you pointed to before. What do you think is priced in at this point, based on the rhetoric going back and forth with China? That's obviously moved soybeans a lot. How much more, like for instance, if trade talks continue to ratchet higher, how much more downside do soybeans have, or what would it take to get soybeans to move lower? Because it seems like there's already been a lot priced into it.
Yeah, I think for the most part, I think we're starting to see that the market is really not. It may react knee jerk upon an announcement, but if you look at today's announcement, China came out and said, okay, this is our tariff list. This is what we're coming back on. These are our retaliatory numbers. You saw the state publication come out and start to kind of take a very anti-U.S. Rhetoric approach, which is new. That's been one thing that's been missing. Typically, when China gets into trade rifts, they're definitely very quick to trash the idea or the image of that other country in their country. And so we hadn't seen that yet. That was something that we'd really been paying attention to. And even in the face of those two things, we did see a little bit of a downturn on Monday in soybeans, but I would credit that more to rainfall across a lot of Iowa and into Illinois overnight Sunday than any sort of trade tension that was there. We're up for the week. We're close to being higher for the week in soybeans. So for now, I would say that in the short term, until we get a better feel for what we're looking at when it comes to production, I think the idea that this Chinese trade deal goes on for an exceptional amount of time is factored in. I think it would have to be something new, getting into a fight with some of these newer countries that are importing. Because as I said earlier, new crop soybean exports are the third largest in the last 5 or 6 years, with the complete absence of China. So, the idea is already there that China's not coming in. That's baked in. The USDA came out and reduced soybean export expectations by 250 million bushel last month, strictly because of the idea that China is going to be removed from much of our demand sector. To me, I think that side is penciled in. Now we have to start to see what takes place with Brazilian production capacity. So we're going to be really turning our attention once we get a better idea as to U.S. production, which is going to take another 4 to 6 weeks here. That'll be a bigger market mover than anything else. But then we have to start, if the Chinese rift continues, then we're going to have to pay attention to what's taking place, not only weather-wise with Brazil, but also their planting intentions. Right now, it looks like the farmers in Brazil will increase their planted acres 3 to 5%. If it does appear as though we could see them increase 5 to 8 or 10% or something like that, that would be very negative. And that would be a result of the trade war, because price and currency fluctuations have made it to where farmers want to plant soybeans. So we're going to have to be watching that. We also, side note, have to watch, because a Brazilian judge did rule that glyphosate, Roundup Ready technology, is not to be used in the country. Likely to be overturned, but that could have a big implication as to what farmers are capable of planting, 8 weeks from now. So we're going to be watching that, see what happens long term. Anymore, I think the short term headline risk is somewhat out of soybeans when it comes to trade. It's more production and things of that nature as we go forward. Long term, it remains. So if we're still battling China in January and we're getting a feel for what the Brazilian farmer's looking to produce, you could see the market move strongly one way or the other based on what's taking place as we move ahead there.
Interesting. We'll definitely keep an eye on it, and we look forward to you updating us in the chat as these sort of developments continue to unfold.
Yeah, for sure. I enjoy sharing whatever I can, and I'm definitely open to any questions anyone may have.
Good. Well, we look forward to having you back. Thank you very much for taking the time. A lot of great information.
Thanks for having me.
All right. We'll talk to you soon.
Yep. Thank you.